Hi, everyone. I'm Kate Clark from The Information. I'm here with Adena Friedman, the CEO of the Nasdaq. We are so excited to talk to you. I can't imagine a better time to be diving into the topic of IPOs.
Great. Well, it's great to be here. Thanks, Kate.
So obviously, first off, I have to ask you, we saw 13 companies, I think, filed to go public about 2 weeks ago now, from Unity to Snowflake to Airbnb. Why did we suddenly see a surge in those IPO filings?
Well, actually, it's been a busy year for Nasdaq all around our entire business. So I think that we walked into the year thinking that it was going to be a robust year, whether it's in our technology business. We power 120 other exchanges with our technology. We provide surveillance technology to the entire industry. We also have a very robust index business. And so we walked into the year thinking that it was going to be a very busy year for IPOs as well as for our technology business. But then we hit March, and suddenly everything changed. And so our volumes in our markets surged. The volumes in all of our clients' markets surged. And so we had a lot of activity associated with managing the markets as well, while we were also bringing our people home. And then we thought, well, gosh, the IPO environment would probably drop off. So we started the year thinking there would be a lot of companies going out this year. We had 182 IPOs last year, and we kind of thought it would be at least a repeat. And then we thought, well, gosh, after March, it likely would be a much slower year. But the IPO environment recovered very quickly. And so while you're right, there were 13 companies that filed last week. We've had actually 132 IPOs so far this year, 95 operating companies go public, and another 37 SPACs. So it's been a very, very busy year so far. And if anything, we're continuing to see a very strong pipeline of companies looking to tap the public markets between now and the end of the year. And we're starting to have conversations about next year as well.
And I want to talk about SPACs, but lastly, why now are we seeing all these filings? I mean, as you mentioned, there was a drought this summer, and as far as I know, we don't have a magical cure for the coronavirus yet. So why are we expecting such a big wave post Labor Day?
Well, actually, we saw only a dip in the IPO environment through March and April, and it started to pick back up in late April and into May. So May, June, and July have been incredibly busy for us. And so with 132 in the year, I think by the beginning of March, we had 32. So we've had 100 IPOs since the crisis really began. I think that the number of companies that you're seeing right now are those that are trying to get out before the election. So they're filing to try to make it so that they can tap the public markets before the election. That usually then creates a gap. I think that in an election year, we tend to see fewer IPOs in the month of November. We'll see a few more in December, and then it goes into next year. So I think that's why everyone's kind of coming out now, is to try to meet the fall timeline.
Okay, so SPACs. SPACs are not new, but there's been an undeniable increase in them amid the coronavirus. What is the connection between COVID and the drought in the IPO market and SPACs?
Well, again, I think that it actually hasn't been much of a drought, but I think that there was an expectation that there could be a drought. And I think that's why SPACs started to come alive. There are twice as many SPAC listings this year so far than there were all of last year. So it's just going to give you a sense of the number of SPACs that are coming out into the market. The amount of capital being raised by SPACs is something like 4 times what we've seen in the past. And so what happened was, starting in April, SPACs have been around for over 10 years. We've actually had 100 SPACs come out and convert into operating companies since 2010. And so it has actually always been part of the capital markets. Mm-hmm. But when the markets did take the dive that they took in March, then I think that some certain individuals were saying, well, gosh, maybe there might be some bargains out there. Let me raise capital now, because the capital markets were still operating and efficient. So let me raise capital to see if I can find a company that otherwise wouldn't be able to get out into the public markets. And so we saw some companies start to raise capital. The markets have since recovered, so that the actual, the latest SPACs are really there with very, very seasoned management teams, very seasoned investors. It's a very efficient way to raise capital. And then you have 2 years to find a good company who is looking to go public, but that does not want the uncertainty of that IPO price. So one of the benefits of a SPAC is that for investors who are looking to sell the company that they've invested in into the public markets, the SPAC gives them a way to do it without the price uncertainty of an IPO. But now we have seen just a very, very interesting and creative SPACs coming out with very seasoned management teams and investors. So it is, I would say it's the rise of the SPAC as a means to raise capital in the public markets.
Do you think it's here to stay at this pace, or is it kind of a 2020 trend that we're going to see this many SPACs and it will kind of die down next year?
Yeah, it's hard to know, honestly, because the SPACs tend to come alive very quickly and go out very quickly. So we don't really have a line of sight into what might come in 2021, whereas we do for operating companies. Companies that are looking to go public, we have a view into 2021 on that. But for SPACs, they tend to kind of come into the markets very quickly and raise capital.
Okay, and what about direct listings? I mean, I know that Nasdaq has filed with the SEC to allow companies to actually raise capital by doing a direct listing, and I think the New York Stock Exchange is taking similar steps. And a lot of companies in Silicon Valley, which we cover, are pursuing this or have pursued it, from Spotify to Slack. I think we've heard a little bit less about it this year amid the rise of SPACs and just, coronavirus making headlines. But what are your thoughts on the direct listing, and why is Nasdaq trying to allow companies to raise capital through that method?
Yeah, I mean, right now, the reason why someone might go out with a direct listing is if they don't need to raise capital, but they do want to tap the public markets and they don't want to lock up their investors for a period of time afterwards. Those are the kind of the key benefits of going into a direct. And so we've actually seen very few directs over the last few years, but a couple of seminal events. We've had several direct listings on Nasdaq as well, but they've been, kind of scattered over time. It's not something you see on a regular basis. The reason why we think that raising capital through direct listing could be interesting is because the fact that it is a less expensive way for companies to consider the public markets, and it doesn't lock up the initial investors to the same degree as a traditional IPO. So if we can create innovation across capital raising, whether it's a SPAC, a traditional IPO, or direct listing, it just gives companies and investors more choices. And so that's really what we're all about, is giving choice to investors. I do think, though, that directs, you haven't seen as many directs or any directs so far this year because, frankly, companies that may not have thought they wanted to raise capital in the public markets are now thinking, maybe it's a good idea to raise some capital in the public markets. So they're moving more towards the traditional IPO.
So tell us a little bit more about the Nasdaq. I mean, I know you're known as a stock exchange, but you also have Nasdaq Ventures. You have a public policy. You do public policy work. Where do you spend most of your time?
Sure. Actually, today, Nasdaq is a global technology company. And as I mentioned at the beginning, we provide the software that powers 120 other markets. The entire industry relies on us for our market surveillance and trade surveillance technology. We have a very robust index business, a data analytics business that serves the buy side, and a private market, the Nasdaq private market, that helps companies manage their liquidity in the private space. So we have become a very, I would say, global and diversified business. But frankly, with our equities exchanges and our options exchanges as the core of who we are, we operate equities and options exchanges here in the U.S. as well as in the Nordics. We own and operate most of the exchanges in the Nordic countries as well. And so it's a much more diversified business today. But it all starts with our foundation. And our foundation is to be the premier equities market for the United States and for Europe, and to make sure we have very robust market capabilities, because everything else we do kind of stems from that capability.
So you have employees or offices in 30 countries. Is that correct?
That's right. We do.
So I imagine it was a bit complicated, or has been a bit complicated, navigating the shift to remote work when your reach expands 30 countries. Can you tell us just a little bit about what March was like for you when you were kind of going through that process?
Well, there were a lot of decisions being made very quickly. Because at the same time that we were moving to a work from home environment, we were managing unprecedented levels of volumes across our markets and our clients, right? So you had this, a lot of market turmoil, a lot of focus on just making sure that we were operating the right way throughout the day. And at the same time, we wanted to keep our employees safe. So we made the decision very quickly, back actually in early February, to start to restrict visitors in Asia. We then started moving to remote work in Asia. So when it frankly came to the United States, we had been already moving in that direction across other parts of the world. I think it gave us a good preview of what was to come. So when we made the decision in mid-March to move everyone to work from home, number one, we knew we were prepared. We'd been preparing for over 10 years to have a complete work from home environment. But also we kind of knew what the protocol should be from learning as to what was happening in Asia. It was a very busy time. We moved to daily calls with our risk team and our senior executive team, making decisions very, very quickly, then moving straight to the market open, making a lot of decisions throughout the day. But then honestly, as we went through March and we started to feel like we'd done the right initial steps, we were able to pivot pretty quickly to that remote environment. We do remote IPOs now, and we have the benefit of the tower in Times Square, where we can project out our clients across the tower and through all the social channels, media channels, without actually having to be here. So there are a lot of things that we've been able to do in a remote environment that make it so we can maintain this environment for a long time if we need to.
And I do want to talk more about remote IPOs, but first, I know you're speaking to us right now from the office. Have you guys transitioned back? You know, I'm talking to you from San Francisco. We're in a different environment. You're in New York. Is it a little bit more normal?
There's a return to normal here. But I would say here, what we've said to our employees across the whole world is that we will not require any employee to come into the office between now until at least the beginning of next year. So while we have been systematically opening our offices around the world, we haven't yet actually opened our San Francisco office, but we have opened the office here in New York. There are very few people coming in. But I have to say, I've just come back this week, and it's nice. I prefer it. It's just my style. I also think that it's an opportunity for me to see people and have a little bit more of a spontaneous interaction. I think that also it'll take time. I have the benefit of not having a long commute. But our employees, I think there's a lot of concerns they have. The schools are not really as predictable as they need to be in terms of allowing their children to go to school. There may be employees with underlying conditions that they want to keep confidential, but that hold them back from coming back. And we want to respect all of that. So we have the benefit of being able to work from home very effectively. And so we are giving that choice to our employees, at least through end of year. I will have to see how the year progresses.
Okay, so the remote IPO, I think, is a very fascinating concept. I mean, from what I understand, the big differences are there's no roadshow, at least there is, but it's over Zoom. And it sounds like it actually may be a more efficient process. Can you explain maybe what the big differences are between doing it all in person over a 2-3 week period or doing it completely virtually?
Yeah, I mean, it is very efficient because you can sit in your living room and do 12 meetings in a row. It's exhausting no matter whether you're traveling or not. But and you can usually get and see most of the investors you want to see in maybe a much shorter period of time. Whereas it may have been 2 weeks on the road, you can do it in 4 or 5 days. We now are seeing IPOs come out into the market almost every day of the week, so Tuesday through Friday, whereas in the past, it really was Thursday and Friday where most of the IPOs were coming into the market. So we have the benefit of being able to leverage our tower more days of the week to support IPOs. And I do think that investors have had to pivot. Investors in the past have benefited from everyone coming to them and presenting, but even then it's only a 45-minute presentation. So if they are able to leverage Zoom and have the same interaction for 45 minutes, I mean, it's pretty easy to do that through a Zoom setting. And I think investors have really, really pivoted to embrace that so that they can learn enough about the company to take the risks they want to take.
Do you think that doing it this way, doing the remote IPO, gives more control and more power, or puts more control in the hands of the company CEO or the company founders who are looking to take that company public?
I would say that it's still the same process of having to make sure that you're telling your story the right way to a lot of young investors who are coming in and kind of learning about these companies. And it's been pretty fast and furious because there have been so many IPOs. So I don't know whether it puts more control into their hands or whether it's just a more efficient use of time. But if you're a CEO, the one thing that you want to have more of is time. So if you can do things faster and more efficiently, it's going to benefit the company and it's going to benefit the industry.
I mean, in that case, do you think that these new methods of taking companies public are here to stay? And actually, on the same note, do you think moving forward, you will be more friendly to the idea of workers being fully remote, even if they don't need to be?
Yeah. So on the IPO question, I actually do think that this is going to be something that could be a trend that's here to stay. I mean, if it can be done efficiently and effectively, and investors feel like they understand the benefit of the risks and benefits of the investment decision without having to have someone in person, I think that could be a trend that's here to stay. In terms of our own employees, I definitely think we are going through the process of understanding what kind of an environment do we want to have going forward? How do we want to accommodate a more remote setting, or at least partial remote? We're going out and surveying our employees around how do they want to work in the future. And we have a committee of senior executives that are really focused on the future of work here at Nasdaq. So we're going through that process right now. I do think, though, that there are benefits to the community being in person at times. You know, that, as I said, that spontaneous interaction, the idea generation, and just that sense of culture and community are things that we want to preserve while giving people more flexibility. And that's the challenge and the debate that we're having internally.
So throughout the coronavirus crisis, you've spoken about the notion of cooperative capitalism, explaining that businesses have really stepped up during the crisis and have been more collaborative than ever before. So first of all, can you just explain to the audience what this idea of cooperative capitalism is?
Sure. Yeah. So if we think about going back over a year when the Business Roundtable came out with the new definite, purpose statement for a company, they basically opened the door to a broader discussion of what are the roles of companies in their communities around them, with their employees, their clients, their suppliers, and other constituents that, frankly, do make it so that these companies can be successful over the long term while also meeting the needs of the shareholders. Well, I think that if we flash forward over to this year and we saw what happened in March, where companies were taking unprecedented steps to change over their manufacturing plants to manufacture PPE, or we saw some grocery stores which were buying up produce that otherwise would never have been sold and then donating it to the food banks around them. Those were just great actions that were taken for the betterment of the communities around them. We needed them to do that, and they did. They stepped up. And I think if we can then take that forward past the crisis and we say, well, what does that mean going forward? Are there ways for companies with the private sector has the benefit of being nimble and being able to attract great talent and being able to be really innovative. The public sector has very large problems and programs that they need to be able to implement that really change society, or could change society. So can we find a way to bring the benefits of the private sector and the public sector together to solve some of our bigger challenges while getting the benefit of the corporate environment and the corporate benefits of that nimble innovation? Mm-hmm. I think that those are the types of things that we need to think about as we recover from the crisis, as we kind of take that long economic recovery and hopefully come out of it a stronger economy. But we'll have to see how that goes forward.
And are you optimistic that companies will indeed continue to come together when not faced with a crisis of a generation?
Well, I do think that these types of moments definitely bring people together in ways that may not happen in a normal business environment. But if there's a common goal that we're all trying to reach, let's say to improve education or to improve infrastructure, I do actually think that companies can be quite collaborative when they need to be, when there's a common interest.
Well, we're just about out of time, but I do want to ask, I know it's incredibly difficult to speculate right now, especially, but do you suspect that this IPO activity will continue into 2021, aside from November, which you already made clear is not the best time usually for companies to list?
Well, at least that there are a lot of companies that are already starting to plan for the first quarter of 2021. So I think that obviously the market environment and the economic environment are pretty uncertain right now. So it's hard to be able to predict what happens in 2021. But I think if we continue to see progress on the vaccines, potentially even see a vaccine rolling out in the beginning of next year, I think that'll continue to give people confidence that we can make our way through this. And those companies that have been leaning into the trends will continue to have those trends. Those trends are just accelerated long-term trends that we were seeing in society. So I personally think that there will continue to be an active and open environment if we can see progress to solve this major issue, which is, of course, the virus. And I think if we do not see that progress, then I think then things could get a little bit more challenging next year.
Well, we will be keeping a close eye. Thank you so much for joining us. It was great talking to you.
Thank you very much.
All right, we got a lot of questions that rolled in during that, so I'm just going to jump right into some of these audience questions. Let's see. What do you think about California's board gender mandate for public companies and the new state law proposing diversity quotas? Can we go federal with these mandates, or can the Nasdaq develop their own requirements?
Oh, well, first of all, I think that what California did really was groundbreaking for this country. I think there are several other countries that already have those types of mandates, particularly around gender, and they have been effective. We own and operate most of the exchanges in the Nordics, and one of the countries where the mandate came into play about 10 years ago was in Norway, and there's been a lot of work done to say what effect has it had since it's been 10 years. And you can see a lot of positive effects from that requirement. So I think that certainly what California has done could be groundbreaking for this country. If there's a federal requirement, then it would have to be done by the SEC. And I think that, that's not an area that I've seen them focusing on in recent years. At the end of the day, it could also become something that the exchanges choose to consider. And certainly, as we're looking at our role in society and our role in the communities around us, it is always something that we're willing to engage with our clients on and understand, what the areas are where we could play a role. So whether it's a true mandate or some level of disclosures and other things that could accompany a diversity plan, those are the types of things that we're always willing to engage with our customers on.
But it's really in the SEC's hands in order for there to be a federal mandate.
Yeah, if it's to be a federal mandate, it would go straight into the SEC's hands. They can also look at it both in the context of public companies as well as private companies, because they do also have regulatory oversight over the private equity industry and the venture industry. So if they wanted to make it so it was a broader mandate beyond public companies, they do have the authority to try to do that.
How did you grow in your career to become an executive? Can you share some tips, mantras, and/or traits that have helped you?
Okay, well, that's a big question. I think that the first thing is I am an eternal optimist, so I tend to try to figure out how to get things done. So instead of focusing on what's wrong with the proposal or what are the impediments to progress, I'm always trying to break down those impediments and march forward. And I think I've done that from a very early age. So I was able to take on projects in my 20s where the company was, I worked at Nasdaq, started working at Nasdaq in 1993. So I've been here for a long time. And the company gave me projects where I had to just figure it out on my own at 25, 26. And I was always there to try to, make sure that I made progress and I solved problems, kind of owned products or projects in a way that definitely got them done efficiently and effectively. So early on, I took ownership of things. I think the second thing is that I really enjoy working with other people. I'm a pretty strong communicator, both in terms of advocating for a budget or advocating for a project or advocating for a deal. And I think that also helped a lot in terms of my ability to communicate the needs and then articulate them really well. And then obviously then follow up with execution. So I think those are the things that really propelled me forward.
Am I remembering correctly, did you start at Nasdaq as an intern?
I did, yes.
And you have been there since, or did you step away at any point?
I did leave for 3 years. I left in 2011 and went to the Carlyle Group as their CFO, helped them go public and establish, a public company type of finance function there, and then came back to Nasdaq in 2014.
Wow. Will clients who conducted a remote IPO be able to come to the office post-COVID for the ringing of the bell, a pivotal moment for organizations that make it to that momentous occasion?
Yeah, we're really looking forward to working with companies that have had that remote bell experience to find opportunities as a public company to be able to come back and celebrate, whether it's a milestone in their company's history or a new product launch or a way to engage with the communities around them. We certainly want to make sure that companies have the opportunity to take advantage of the Times Square presence when it becomes openly available again. So we certainly will be discussing that with our listed companies and those that are newly listed for sure.
So they'll probably get to come in and get their photos taken and kind of have that moment, even though it's not the real thing.
Well, for our listed companies, we have companies come back multiple times to ring the bell. It could be, based on, a 1-year milestone or a 5-year milestone. It could be based on new things that they're doing that they want to make sure they get publicity around. we do have to work around the IPO schedule itself to make sure that those new IPOs also get the chance to have that experience. But we do work very effectively with our companies to enable them to come in after they've gone public.
This person says, a question you probably get all the time. You watch lots of companies IPO. What common pitfalls do you see that we should watch out for?
Good question also. Okay, so I think that the one element that's always the most challenging is determining, quote unquote, the right price for the company that night before. So I think that there's obviously a lot of work that goes into creating a valuation for a company with the underwriters, then verifying and validating that valuation with investors, both before the roadshow and during the roadshow. But there's frankly that moment of understanding true supply and demand and investor sentiment, what's happening in the markets, et cetera. There's a lot that goes into getting that price right. So my general view is that it's a fine balance between leaving money on the table by pricing it too low and taking too much upfront and leaving the investors with a challenging experience. I personally think that if you have, if you're kind of on the cusp, should I raise it $1 or should I not? My general view is leave a little bit of money on the table to give the investors the right early experience, because it'll pay dividends over time in building trust. Mm-hmm. But I also believe that this year in particular, it's actually been hard to find that right moment and that right value. So it's never a perfect science. But that's the one piece of advice I always offer to companies.
Yeah, I mean, we didn't get into this in our Q&A, but there's certainly a lot of criticism amongst Silicon Valley investors about, companies leaving a ton of money on the table, but probably a topic for another time.
Well, I also think, Andreessen Horowitz recently put out a really, really well-researched paper or article around this issue of, are companies really leaving money on the table or not? Or is it really, you have to recognize if every single stock, every single share of the company if it were available the day of the IPO, would they actually be able to sell the stock at that same value, and would it go up at the same amount? And the answer is no. So usually the scarcity value of the fact that a lot of companies are only floating 10 to 15% of the company creates some scarcity value that does create more run up than may otherwise occur. So that's a little bit of what's in that piece. I would say it's a really well done piece. Also looking at the alternatives of direct listings and SPACs. I mean, I thought it was a very well balanced piece.
I'm sure it'll be an ongoing debate. How much of the current froth in the Nasdaq is due to the surge in retail participation? And do you think new and imminent issuers are rushing in to take advantage of these young, unexperienced investors?
Well, first of all, most of the time when a company is IPOing, they're going in and allocating their shares to professional investors, to institutional investors. There tends to be some retail component to the allocation, but for the most part, they're allocating to institutional investors. So companies, in terms of the money that they're getting in the door in connection with the IPO, tends to come from institutional investors, which means that they have done a fair amount of homework on the company prior to going public. I think the post IPO performance of the company then introduces other investors into it. The level of retail involvement in the market has definitely gone up in the last few months. I've seen numbers, but I haven't validated them, that say that on average over the last several years, we've had about 15% of the trading volume coming from retail investors, whereas in the last 6 months, it's gone as high as 20%. So it does give you a sense of how much of a change in the level of retail involvement. But I also think that institutional investors are looking for risk capital to put to work. I think they are also willing to lean into trends that are changing the way we work going forward, or the way we shop and things like that. And a lot of the companies, how we access healthcare, what kind of healthcare is available, all of those things are the types of companies that have had a very good experience coming out into the market. So both institutional investors and retail are engaging in that and finding good opportunities there.
What are a few key financial skills or concepts that you believe all female founders or executives should master? How would you encourage young women or recent graduates to position themselves to learn these?
So I certainly think learning how to read an income statement, a balance sheet, and really understanding the concept of a balance sheet. So I would say accounting 101, and I'm not kidding. So I went to business school and I took accounting classes. But before that, I actually did an accounting class at a local college, just so that you could understand the basics of financial statements. I think then also that gives you a foundation to be able to understand then how the inputs, the drivers of businesses affect the ultimate outcome, understanding cash flow, all of those types of basics. You'd think that that's part of a foundational education, but for most liberal arts majors and people who are not business majors, that's not part of their formal education. So finding an opportunity to take some sort of basic accounting, I think, is a really important way to get started. But honestly, until you learn to apply it, so until I became the head of corporate strategy at Nasdaq back in 2004, understanding how to really leverage those skills to be able to evaluate M&A, I would not say that I really understood the value of understanding that information until I had to apply it in that way. But I think that's a really important foundation for anyone entering the business world.
On a similar note, as a woman executive, how do you balance work and life, especially during the pandemic?
Well, I'm very fortunate because my children are grown. So I have two sons, and one is 24 and one is 22. So in this period of time, they did come home and live at home for a while, but they were very helpful. So they would make dinner. They were really, really helpful and contributed to lowering my stress levels, not increasing them. I do very much empathize, though, with parents who have younger children at home, and just, to me, truly the tragedy that many of our children today are not able to go to an in-person school and have that social experience. And then the pressure that puts on the parents to create that social experience and the learning experience and everything else while they're managing their jobs. So Nasdaq, actually, we've been trying to find the right way to balance that with our employees, giving our employees extra what we call flex days every month to give them a chance to manage their home responsibilities, but it has been very challenging. In terms of myself, I had children really young. So I was early in my career when I had the kids, and that, I think, helped me because I've always worked with children. So meaning I've always had children while I've been working. So I've had to work with my husband to find the right balance between the two of us. I worked part-time for a few years. He worked part-time for a few years. We also made sure that we always covered for each other. We had a great partnership throughout the child rearing years, but there were definitely moments of great stress and feeling overwhelmed. And at those moments, I encourage women to talk to your parents or your mother. That's who I talk to. Or if that's not available or doesn't quite make sense, then find a trusted friend at work or outside of work just to unload. And then also talk to your manager, because managers of high-performing women desperately want to figure out how to make it so that the women can continue to work effectively and not have that sense of being overwhelmed. And many managers are very much willing to work with women to figure that out with them. So don't assume that avenue is not available to you. Make sure that you have an open relationship with your manager as well.
That's great advice. And I think on that note, we can wrap up. So thanks again. It was great having you. We really appreciate it.
Great. Thank you very much.
At Intuit, we believe you cannot have prosperity without equality. Women and people of color should not be paid less than men for the same work. 3 years ago, we made a commitment to reach and maintain pay equity for our employees. But pay equity is an ongoing process, and all companies must join this fight. Like the 19th Amendment, we are not done.